Welcome to Channel 17, the Town of Colonie Government Channel.
Hello and welcome to The Money Factor. I'm Richard Naylor, your host. Today we'll be talking about the economic climate of New York and of the investment area. Our guest is Frank Marchesini from Edward Jones, and we're happy to have him back on the show. I want to thank you for coming back.
My pleasure. Thanks for having me back, Richard.
Where we could start, I guess, I think back to last year, which is now just a few weeks away. And I don't know when it started, but people were talking about the housing bubble in a way that wasn't just, wow, it's getting big. It was more worry. And since then, we've learned words like subprime. And so what's going on? What's going on with the housing, and what's our situation?
Well, I can just provide you an overview on what we've seen here in the last 6 months. Basically, when you look at the problem, there's two types of concerns out there. There's something called subprime, which are mortgages made to individuals that have poor credit, and then the Alt-A, which were mortgages made or originated from people that didn't provide financial verification. So
they might have been good and might not have been good?
Or just the process was short-cutted.
Okay.
But in either case, it presents a significant part of the lending practices over the last year or two, and that problem now obviously has presented itself, and each will present a different problem in terms of a foreclosure probability. The Alt-A folks now have potential for those interest rates to rise, and it'll increase concern about them making payments. So, I use an analogy of a python swallowing a pig. We've got that in the system now, and that's got to work itself through. And over the next couple of years, there could be up to 1 to 2 million homes that could end up in foreclosure, and that's looming out there, and that's obviously creating a lot of concern in the market right now.
Now that's a scary number, but how many homes are there? I mean, when you say 1 million, maybe there's 100 million homes, let's say,
yeah,
or maybe there's 50 million homes.
I don't know the exact answer, but it's the percentages are just much higher than what we've seen typically in the past.
Okay.
So
I mean, it is a high number, and I know that it's doubled in some cases. So, right.
And certain areas are more exposed to it. Florida, California have serious problems. In upstate New York, our current environment is probably not as extreme as those areas. So,
I kind of stumbled into this in my introduction to the fact that, are we talking about local, or are we talking about national or international? And since we're really talking about investment, we're talking about international. But probably people will put more money in U.S. companies.
Well, right now it's certainly creating volatility in our U.S. stock market. But when you look at everything now, you have to almost view globally when you talk about your investments. But when it comes to a problem like this, everything is locally. People look at their neighbors, their friends, family. I'd like to, at some point tie this into how do I advise my clients when it comes to a problem like this, and whether they're looking at buying a home. I would recommend that you're looking at a home purchase from the standpoint of a piece of property that you want to live in, and you're going to build equity over time. Some folks are still very motivated to get into real estate from an investment standpoint. I would advise that please understand all of the ramifications of doing it from an investment standpoint. Typically, people enter the market when it's high and then realize after it drops that they've bitten off more they can chew. You know, there's a lot to the process, and just make sure you do your homework, or you're working with somebody that understands the business. Have the patience and discipline, and don't overextend.
I think that's a really good piece of advice. Not that I would have known to give it, but I mean, I've talked to people who have thought, maybe naively, maybe cleverly, and who am I to judge? Maybe this is the time to buy something because there's all this property. But since I don't know enough about it, I would certainly not advise. I mean, myself, I'm not an advisor, but I wouldn't encourage them or discourage them. I have no idea.
Well, in real estate is an investment asset or a category just like stocks and bonds, and it has to be treated as an overall part of your overall financial
Not
plan.
an exciting area where you're going to make a killing right now.
Well, that's what people hear. You hear there's infomercials now about how to, you know, get rich quick in real estate, and you just have to remember that those situations are, you know, are isolated, and you know, if everybody could do it, we'd all be doing it.
I like that.
But that's the reality, is that's not the case. So you just need to understand what you're getting into and do your homework.
Good advice. I have even heard people trying to sell real estate as a way to get out of debt, which to me is like, if you got yourself into debt, maybe you're not the person who should be making a big investment in real estate to get out of debt.
Right. Well, that's a great point. And I think a lot of that is just people trying to sell something to unsuspecting individuals that are just looking to, you know, hit it big. And the reality is that doesn't always happen.
And that was a little bit of the problem with the banks lending to people, because there are all these pressures to keep providing a bigger return.
Unfortunately, as humans, we have where people can get greedy and overextend, and the market gets overheated, and that's you know, these types of corrections are just they happen.
It not only predicted, but probably necessary.
Yes, absolutely necessary. You have to get back to you know, a more normal, reasonable state, and that's what we are. Unfortunately, people get hurt, and that's the sad thing about it. But
so when we talk about the climate, I guess the bigger question for people, aside from the curiosity of what's going on and I don't understand it, is, well, stocks are scary because everything goes up one day and down, and today we may be sitting on the Dow 12.6, and we were up to 14 last year, and I don't understand what's going on. So do I do that, or do I put my money into mutual funds, or should I look at bonds? I think people really right now are especially anxious about whether they're doing the wrong thing.
I've been actually spending a good part of this month getting folks ready for 2008, and one of the questions I've been hearing is, you know, are we going into a recession? What do you think's going to happen? Well, I don't know. Whether we go into a recession or not, I don't know. But what I do advise is, let's take a look at your investments and understand why we own them. And if we do go into a recession, are you comfortable having these assets? If you look at how investments perform during a recession or a down market, you know, some of them behave like a tennis ball. You drop the tennis ball, it's going to fall, but it bounces back. If it's not a good quality investment, it's like an egg. You drop it, it stays down, it never bounces back. So, you know, if we do go into a recession, they tend to be short. On average, they last 10 months. Usually by the time we're in it, we're out of it, because usually the media is behind the curve.
Right, what do you need, 3/4? Do you need 3/4 of dropping productivity to have a recession? Which would make it 9 months before they even had an official recession that started 9 months before.
Yeah. I can just tell you that if you look at studies that when they actually start really reporting about a recession and it's headline news every night, we've actually worked out of it from an economical,
so whether it's a
statistical
month
standpoint.
or a quarter, it's...
Yeah, but the whole point is you can't allow your investment philosophy, worrying isn't a strategy. It's about objectively looking at what you own and saying, am I in a position to ride this out? And that's where having professional advice or understanding what you own, it's a discipline that it has to be put in place. Not everybody does it.
And probably your age, your family, your goals, all these things.
They all come into play. Typically, if you've got a time horizon where your investments aren't really going to be needed for some time, then what happens in the next year really is of little consequence. It becomes more problematic for retirees or folks that are nearing retirement, where they won't have the luxury of adding a lot more money to the account. The volatility becomes more of a concern. But those are the things that have to be looked at on an individual case-by-case basis.
So if we look at the climate again, I guess one of the most recent things that's helped the market is the idea that the Fed may once again come to our rescue. What's going on there?
Well, the Federal Reserve is, on a delicate balancing act right now because there are concerns about inflation, which when you look at where we are inflation-wise, we're below historic levels. Our inflation isn't out of control, but still there's a concern about that growing. And at the same time, if they lower rates, or if they don't lower rates to keep inflation in check, the markets are viewing the whole idea of growth, and they're looking for relief and downward actions on the Fed. So it's a difficult balancing act. But whatever happens, again, part of what I do every day, and then as an investor, you can't worry about that because you can't control it. You should only worry about things you can control.
Right.
And we can't control what goes on in the marketplace with the Fed. So have a strategy that encompasses what if they lower rates, what if they don't, and that's all you can do.
And I guess mixed into that now with the inflation picture, just to paint a little more of the detail in, China's perhaps driving up the price of oil, although we've seen it drop back a little bit in the last couple days. The oil barrel price, I think it was 93 or so, off of 100. But we're still not going to probably see $50 oil. At least that seems optimistic at this point, even though experts were saying 50 was the natural place to be. But here we are at 95 and thinking, well, maybe that's the natural place to be. So we've got all these things where our costs are going up in order to make anything, plastic, computer chips. And it seems hard to understand how we wouldn't have inflation when such a basic component of what we buy is made out of oil, and that's getting more expensive.
Well, that's absolutely true. Our economy, 25, 30 years ago, a greater percentage of our economy was driven by fuel or energy cost, and it's much lower today. It's approximately 10%. We're much more of a service economy. But with that said, where we do have increases in energy and a lot of other areas, we also have inflation reducers. Technology has helped us become more productive. Our labor costs have been kept in line through global competition. There's a lot of factors that help offset the energy increases. So again, energy is something that from an investor standpoint we can do little about. I know it impacts us when we go fill up our gas tanks, but in terms of how we manage our portfolio and how we approach investing, it really shouldn't enter into the equation. It doesn't become something that we can control.
But it would be risk, I guess, if you look at volatility, and we're all told volatility equals risk to some extent. Although I don't want to buy any eggs. We're talking about these eggs. We don't want those. So with that in mind, there's always going to be risk, but how do we pick at a different... wouldn't there be today more risk in certain areas than other areas? Like, shouldn't we say, well, maybe more bonds today and fewer stocks, even if it's not much?
Well, that's a great point. There's always going to be risk present, and every asset category, whether it's a small cap, a large cap stock, a bond, Whatever the type of investment, there is risk inherent in that. And as an individual, what you have to look at is what is the risk within that investment? What is that investment doing for me? Am I comfortable with the risk? And on a case-by-case basis, really look at what your investments are doing for you, and then you have to build, factor that into the whole picture. And I constantly do asset allocation reviews with my clients. Their needs change. As you get older, presumably you're becoming more conservative, preservation-minded, and those types of adjustments have to enter into the equation. Sometimes people just get tired of the volatility and they decide they need to get to more conservative investments. So making those decisions objectively is the most important thing, and not making decisions based on turning the news on and seeing the market drop 280 points and saying, well, I'm selling everything, I'm getting out, because then you're making decisions based on emotion and not objective, factual, need-based reasons.
Right. Unfortunately, I guess we're made such that we are emotional, and we don't like to lose, and I guess I just try to really avoid thinking about that as money. I mean, if it's in my retirement account and the market drops 10%, if you think about, I just lost today. Well, how do you feel today? Well, not too great because I just lost X thousand dollars. I don't even think about that as money. It's just something that I'm looking forward to using later.
Well, and that's the way you should look at it. If you're looking at a retirement account that realistically you're not going to be actually accessing for 10, 15, 20 years, and you're anxious about daily up and down swings, you're really not doing the right thing for yourself. There's other things you should be more concerned about. But that's why people like myself, that's why I'm in business, is I deal with this every day, and
kind of a shock absorber.
Well, I work with people to help them remove the emotional component to making investment decisions as much as possible.
Well, and that's part of our climate. If our theme today is economic climate, I guess we would say it's not totally sunny. I don't know if it's pouring.
Well, I do know that this has been an exceptionally choppy and turbulent 6 months, and I think a lot of what's going on is really fueled by the fact that news travels more quickly. Everybody's plugged into CNBC or has the ticker symbol at their computer. And it's amazing to me the psychology of how things are reported, in that, if the market drops 280 points, that's a headline story on the 6 o'clock newscast. Yet the following Monday, the market can rebound 330 points, and it's buried in the middle of the newscast as they go to the commercial. I think the psychology is that bad news gets headlines, and people then tend to respond to that, and that becomes their first concern. And you really, again, have to step back and say investing is a long-term process. You should be patient. There will be volatility, and just not allow the short term to cloud your long-term thinking. Easier said than done.
Easier said than done, but with a little encouragement, I guess it helps.
Absolutely.
Big stocks, small companies. I've heard people recommend large companies for a long time, and it seems like the small caps had been doing better, let's say over the last 10 years. Has the thinking changed? Is it finally the day for the large caps to come back?
Well, I don't think the large caps really have ever really left, but more importantly, as an investor, those types of decisions on whether to go to small cap or international or emerging market, you have to be careful about trying to chase the trends. Usually, a lot of folks will say, you know, small cap is the place to be, and they'll move assets into that category. Well, by then you're buying it at the point where it's at the high, and again, everything cycles. Rather than trying to predict, you know, what is going to be the next hot sector, you know, whether it's energy, healthcare, or whether large cap, small, or international, you should consider balancing and having your assets properly diversified in all areas. And
So
then
bonds would be a part of that?
bonds would be a part of that. Bonds provide stability, or even more importantly, they provide income for folks looking for income. But trying to chase trends or chasing the hot investments ends up being a fool's game.
Okay.
And that's the funny thing about investing is you almost, in some cases, have to think contrarian, that most people want to buy when everything is high. They're hearing about it, it's getting headlines, yet nobody wants to buy. You know, the financial sector right now is just being hit so hard, nobody wants to own a bank stock. Yet that's really, if you have the patience, those are good opportunities right now. But people don't think that way when it comes to investing.
I guess a lot of people don't, and it's harder, right?
Most people don't.
It's
You're
hard to
right.
think that way.
Well, it is. It absolutely is.
And yet you think that for everybody who sold, somebody on the other side saying, I think I'll buy that.
That's right. That's right.
Something I've always had a hard time understanding why it's going down.
But it's extremely difficult, if not impossible, to predict where things are going. So, you know, just having investments that are suitable for you, that provide dividends, or you know, are companies you want to own, that's the strategy, rather trying to chase money from A to B.
Well, okay, you mentioned financials. They've been battered, of course. Let's move a little toward the dollar. The dollar has dropped, but we're not getting a lot of publicity anymore. I think it's kind of stabilized, maybe, because a few months ago, when it hit $1.40, I mean a euro, 140, people were every day, here's the new news, 139.6, 139.8, and every tenth of a point we were getting a news flash, and now we're not hearing much. However, the euro, it does have a role, and the dollar seems to have gotten weaker, but our companies are spread all over the world. How do we think in terms of international investing when it's hard not to be internationally invested?
Well, international investments have absolutely been stellar performers the last at least 2 years. You can invest internationally in a few ways, and I'll outline them. First of all, you can buy individual companies that are traded and based overseas, but it's difficult to buy those on foreign exchanges. It gets a little cumbersome with currency and dealing with other markets. You can simply buy multinational companies. There's great companies that are based in the United States, healthcare companies, consumer products companies that have businesses based overseas as well, and most of their growth is overseas. For example, soft drink is basically a flat market domestically, but the growth is in China and all these emerging,
Right.
emerging markets. But then probably the easiest way to get diversification is buying using a mutual fund that has an objective to invest overseas, and then you're getting the benefits of diversification and active money management. But the growth rates overseas are higher than they are domestically here, and the fact that the dollar is down, it's allowing us to export goods overseas. We're a global marketplace now. We should have part of our investment dollars invested to take advantage of international growth, without a doubt.
I think that that's really an interesting area to look at, because everything is so intertwined. And when say GE or General Motors trying to push cars in China, Procter & Gamble selling diapers in Japan, and all of these things. So then those dollars that they sell come back, but they were in yen, or they were in euros, or they were in won.
Right, right.
Then that gets reconverted, and they get extra profit from those. So,
you know, the whole idea of the currency exchange issue enters into it, and that's why when I mentioned about actually, you know, when you're going to invest, most people don't have the wherewithal or the inclination to go and invest their own dollars overseas. That's why using things like, you know, funds or exchange traded funds, that's the way to do it. But, you know, I had a lot of people ask me about China. You know, should I invest in China? That's been extremely growth market, not only from an investment, but just an economic standpoint. And, you know, what's interesting is they are still way down low on the gross domestic product per capita. But the rate at which they're growing is tremendous. And, you know, there's 2 billion people in China, and those folks now are starting to get disposable income to buy things like Coca-Cola and, you know, the basic staples that we take for granted here. They're going to be able to start purchasing, and that's why having investments involved in companies that are serving China is phenomenal, because it's just such a huge untapped market.
How do you do that? Because it seems like whenever you deal with something that's an emerging, whether it's a market or a market area, such as in energy, where we're looking for alternative energy sources, and if you invest in a company that's got a chance to be huge. I remember when Plug Power people were saying it's going to be 10,000 times bigger than it is now, and it shot up to 150. But it was so far from being at the point where it was going to really make a lot of money. And China seems like we've had a lot of companies that kind of broke upon the shore rather than came ashore and flourished. How can people safely invest in a market like that?
Well, I would caution investors to want to invest a large percentage of their capital specifically in China. There's still a lot of risks. There's you know, political risk. There's a lot of risk in that area. But if you invest in companies that are doing business there, General Electric, the large companies, your risk is spread because their entire business isn't resting on the future of China.
Right.
But it does represent a huge growth potential for them in their business. And just be careful. Again, China, just like Plug Power, any other area that's developing, represents an area that people feel the returns are just going to be endless. And that's usually, you know, at some point, what goes up very quickly ends up, you know, correcting. And you just need to make sure you're not overexposed.
And I guess patience up to a point, but when does patience become foolishness?
Well, I guess if you own an investment that was never a good quality investment to begin with, and it's declined, you might be waiting for something that will never happen. And you just have to understand that maybe emotionally, maybe it wasn't the best decision you made, and take your lumps and move on.
Okay.
I have folks that have owned things for a long time that they didn't buy them through me, but they've owned them, and they ask me, well, should I wait? And you know, who knows? But if you're not happy with what it's done, cut your loss and move on.
Okay.
You know.
I guess one more area, we're about out of time, but we're also coming up on tax time, that ominous point of the year. And you said you were helping people kind of get ready. Is there anything at this point that still can be done relative to taxes last year, or is it pretty much over?
Well, actually, it's a great Great point. I would encourage folks that if they haven't funded their IRAs fully for 2007, they can still do that in 2008 and take the deduction if they're eligible against their 2007 return. Fully funded if you can. You have up until the point you file your taxes or April 15. Going forward, the IRA contribution limits have gone up to $5,000 for individuals and another $1,000 for folks over 50. Take advantage of that. Fund them as early as possible. Look for ways to reduce your taxes on your income, tax-free bonds. There's a lot of ways. But ask your tax advisor, your CPA, for ways to reduce your taxes through investments. They'll certainly give you advice, but sometimes you just have to ask.
And it never costs anything to ask.
It doesn't cost anything to ask. But, parting comment, just be patient this year. It could be a very, very choppy, lackluster year. I'd rather plan conservatively and plan for the worst. We hope things will be better, but rather than being caught off guard, do a thorough inventory of your investments, understand why you own them, what are the risks, and then you're doing everything you can.
So that sounds like very good parting words.
Well, that's words to live by for 2008.
Very good. Thank you, Frank.
Richard, thank you for having me. I enjoyed it.
Thank you. And I want to thank you for watching. I hope you enjoyed the show. And I want to invite you to our next show and wish you a great week. Take care.
Welcome to Channel 17, the Town of Colonie Government Channel.